Welcome back to Algobot, the channel where we take apart automated trading strategies and study how they actually work, one line of logic at a time. I'm your host, and today we're examining an expert advisor for MetaTrader 5 called mean-crossing cadence regime. This is an original, first-principles system that leans on a single idea borrowed from signal processing, which is how often price crosses its own average. By the end of this video, you'll understand the statistic that drives it, how it switches between two different trading styles, and how every entry, stop, and target is constructed. Let's get into it. Mean-crossing cadence regime is a regime-switching expert advisor, which simply means it changes its behavior depending on what kind of market it detects. Rather than relying on any named indicator, price action pattern, or popular method, it is built around one raw statistic. Over a rolling window of recent closed bars, the strategy calculates the arithmetic mean of the closing prices, and then it counts how many times price flipped from one side of that mean to the other. That count, divided by the number of bars, produces a value the strategy calls the cadence, often written as kappa. In plain language, the cadence measures how quickly the market is oscillating around its own average. The idea comes from level crossing theory in signal processing, where the rate at which a wave crosses its center line reflects its dominant frequency. When the cadence is high, price is flipping across its mean constantly, which points to a fast, mean-reverting market. When the cadence is low, price is parking on one side of the mean for long stretches, which points to a slower, more persistent, trending market. The same single number decides which playbook the strategy follows, and price's position relative to the mean decides the direction. This expert advisor is designed to run on liquid instruments such as foreign exchange majors and metals, and it was built with the 5-minute through 1-hour time frames in mind, though it locks to no specific time frame and simply uses whatever chart it is attached to. It is best suited for traders who are curious about systematic, rules-based approaches and who want to understand the reasoning behind each decision. As always, this is educational information only, and trading carries real risk, including the risk of loss. Let's walk through the mechanics step by step. The expert advisor acts once per newly closed bar, so it makes decisions on completed candles rather than reacting to every tick. On each new bar, it looks back over a window set by the parameter LookbackN, which defaults to 40 bars. Across that window, it computes the mean of the closing prices, and it measures a robust yardstick of volatility called the mean absolute deviation, or MAD, which is simply the average distance of each close from the mean. Because MAD makes no assumption about a bell curve, it adapts naturally as volatility expands and contracts. Next, the strategy counts the sign changes, which is the number of times a close moves from below the mean to above it, or the reverse. Dividing that count by the window length gives the cadence, kappa. The strategy compares kappa against the cadence threshold parameter, which defaults to 0.35. If kappa is at or above the threshold, the market is treated as mean-reverting and the strategy fades. If kappa is below the threshold, the market is treated as persistent and the strategy follows. In the mean-reverting regime, the strategy measures how far the latest close sits from the mean, expressed in MAD units. This value is called Z. If Z rises to or above the EntryZ parameter, which defaults to 1.6, price is stretched above its mean, and the strategy signals a sell, with the take profit placed back at the mean itself, acting as a magnet. If Z falls to or below the negative of EntryZ, price is stretched below its mean, and the strategy signals a buy, again targeting the mean. In both cases, the stop loss is placed at a distance of ATR stop multiple times the ATR, defaulting to 2 times ATR on the far side of the entry. A minimum reward to risk filter, defaulting to 0.7, rejects any fade whose mean target is already too close to justify the stop. In the persistent, trending regime, the strategy waits for a fresh crossing of the mean. If the previous close was below the mean and the newest close is above it, that upward crossing signals a buy. If the previous close was above and the newest is below, that downward crossing signals a sell. Here the take profit is set at trend TP multiple times ATR, defaulting to 2.5 times ATR, beyond the entry, and the stop again sits at the ATR-based distance. The strategy holds one position at a time per magic number, and it skips new entries when the spread is wider than the max spread point setting. Here is the heart of the code as it appears in MetaEditor. At the top, we have the input parameters. LookbackN sets the window for the mean and the crossing cadence. CadenceThreshold is the dividing line between the mean-reverting and trending regimes. EntryZ is the fade level, measured in mean absolute deviation units. ATR period, ATR stop multiple, and trend TP multiple control the volatility yardstick, the stop distance, and the trend target. Min-reward risk filters out fades whose target is too close, while lots and magic set the position size and the identifier. Below the inputs are the two range regime blocks shown on screen. The first block handles the sell side. When Z is greater than or equal to EntryZ, price has stretched above the mean, so the entry is taken at the bid. The take profit is set to the mean itself, and the stop loss is placed one stop distance above the entry, where stop distance equals ATR stop multiple times ATR. The code then checks that reward and risk are both positive and that the reward-to-risk ratio clears min-reward risk before calling trade.sell. The second block handles the buy side and mirrors it. When Z is less than or equal to the negative of EntryZ, price is stretched below the mean, so the entry is taken at the ask. The take profit is again the mean, and the stop loss is placed one stop distance below the entry. After the same reward-to-risk check, the code calls trade.buy. Notice that in both directions the mean is the target and ATR sets the stop, so the exits scale automatically with volatility, which keeps the logic symmetrical for longs and shorts. Now let's bring this to life on a chart. What you're looking at is an illustrative sequence for the mean-reverting regime, the setting where the strategy fade stretches back toward the mean. On the price panel, you can see three overlays: the central mean line, and above and below it a pair of bands sitting at the fade distance, which is EntryZ, mean absolute deviations away from the mean. Below the price, you can see the cadence subpanel, showing kappa against its threshold of 0.35. Notice that throughout this whole sequence, kappa stays above that threshold. That is what tells the strategy we are in a range, mean-reverting market, and so the fade playbook is active rather than the trend playbook. Let's follow the first few candles. Price opens near the mean line and begins drifting lower, candle by candle, edging away from the average. With each close it moves further below the mean, and the deviation measured in MAD units grows more negative. On the third candle, price pushes down and closes at the lower band. At this moment, the deviation reaches the negative of EntryZ, 1.6 MAD units below the mean. Because the cadence has kept us in the mean-reverting regime, this stretch is read as a temporary overshoot rather than the start of a trend. The strategy signals along, and you can see the buy entry marker appear where price meets that lower band. The stop loss is placed a set distance below, at 2 times ATR beneath the entry, tucked under the recent low. The take profit is not an arbitrary number. It is the mean line itself, acting as a magnet that price is expected to snap back toward. Watch what happens next. The fourth candle turns and closes back up off the low. The fifth candle continues higher, and price climbs steadily back toward its average. By the sixth candle, price reaches the mean line, and the take profit is met. You can see the take profit marker sitting right on the mean. That completes the long trade. Price stretched too far below its own average. The strategy faded that stretch, and the mean pulled price back, exactly as the level crossing logic anticipates in a fast oscillating market. Now the sequence rolls into a short. After tagging the mean, price keeps its momentum and pushes above the average. The seventh and eighth candles rise, and the deviation from the mean turns positive and grows. On the ninth candle, price stretches up and closes at the upper band. Here the deviation reaches positive EntryZ, 1.6 MAD units above the mean. Once again, because kappa is still above its threshold and we remain in the mean-reverting regime, this upward stretch is treated as an overshoot that is likely to fade. The strategy signals a short, and the sell entry marker appears where price meets the upper band. This time the stop loss sits a set distance above the entry, again at 2 times ATR, above the recent high, while the take profit is placed back at the mean line. Follow the resolution. The 10th candle stalls and turns lower. The 11th candle falls further, and price retreats toward its average. That brings us to the end of our breakdown of the mean crossing cadence regime expert advisor. Today we saw how it measures the mean crossing cadence over a rolling window, how that single statistic decides between a mean-reverting and a trending playbook, and how it builds every entry, stop, and target around the mean and the ATR. We walk through both a fade long and a fade short, candle by candle. Remember that everything in this video is educational information only, and it is not financial advice, a recommendation, or a solicitation to trade. Every strategy carries risk, and losses are always possible. If you found this helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment telling us which strategy to break down next. You can find more at www.allgobot.live. Past performance does not guarantee future results. Trade responsibly.